I'll try to do my best. You probably don't know that Riccardo and me were a classmate at Bocconi University, and as you know, there is always a sort of friendship, and this is very natural between classmates, but also is some sort of, how can I say, rivalry, and so we like to argue and a little bit to vie. So when we discussed about these topics, I told him, Riccardo, I think to make projections up to 2018, 2017, and so, and he made a pause, and so he said, okay, I'll see. And so we saw now that he made sensitivity and projections up to 2060, and so I give up. He looks younger than me, and so on, so, and he's the policymaker. So there is no choice. Sorry? But you made more money before. Okay, we stop here, otherwise we go to lunchtime and the coffee is gone. I'm going to tell you a story. It's the story of probably an unbelievable turnaround in Italy. I mean, the turnaround, the current turnaround is not complete yet, but we are extremely confident that we are on the right way. And as in all the story we start, I had to say, once upon a time, there was the sovereign debt crisis. Where is my presentation? Is there? There was the sovereign debt crisis in Italy. In this chart, you can see how Italy was suffering a terrible deterioration of their debt fundamentals. No GDP growth. We are comparing the pre-crisis period with the worst of the crisis that is 2008, 2012. So deterioration in growth, no GDP growth or recession, lower inflation, widening spread, and high cost of debt. Be careful, as for a company, the cost of debt should be assessed in real terms. And even if there you see 4.3, but if you put in real terms, the real cost of debt was above 3%. In these conditions, we had a modest primary balance, not sufficient to stabilize public debt. And when, with the Monti's government and so on, when the fiscal correction required by the European Union, the ECB, and so on, started, the tightening of fiscal stance had a procyclical effect, provoking a further deterioration in terms of GDP growth, and so a deeper recession. In other words, in those years, sustainability was not guaranteed. We have to be honest from this point of view. And there was a high risk of rescheduling. We were meeting in that time many international investors. Nobody was used to coming from London to Milan. We had to go there. And they gave us 5 minutes, no more than that, just for a sort of, I can say, to be fair with us, but they weren't interested. Italy, in their minds, were already gone. The turnaround instead started in 2013 after the famous Draghi's whatever it takes. But Draghi is a great central banker, but he's not a magician, he's not a wizard. And Draghi could say that, whatever it takes, because before Italy implemented a huge fiscal adjustment, and the EU built up a new institutional architecture at the EU level. So we had the main improvements on all fronts. Recession was less severe. We had a lower cost of debt and an important increase in the primary balance. Which one? The cyclical adjusted primary balance. We have always to look at that. Notwithstanding that, we had an increase in the debt ratio of about 10 percentage points. But now we have to look forward. And as you probably know, you probably do in your companies, you are CFOs, you look at the debt conditions, the debt stabilization condition, that for the public sector is more or less that formula, which says that the target primary balance, in other words, the primary balance required to have a stabilization of the debt ratio, that primary balance is a function, first, of initial conditions, second, of GDP growth in real and in nominal terms, don't forget the deflator, and third, the level of real interest rates on public debt. In other words, it's more or less what you have in your companies, such as the EBIT minus provisions and amortization. The primary balance is not so different from that. So let me look at this situation. The initial conditions do matter. This is a point already raised by Riccardo. And substantially, the issue is that the higher, or better, the lower the debt ratio, the lower the primary balance required. In other words, passing from 120 in terms of GDP to 130, this during the last period, implies nowadays that the primary balance required to stabilize the public debt or to reduce it in 30 years should be higher by 0.4. Let me show now our expectations regarding the different variables which are crucial for debt sustainability. The first one is GDP growth. GDP growth is back, and this is an extremely important improvement, and is back after a very long, a prolonged recession, which implied a cumulative drop in Italian GDP by more than 10%. Here we have our forecast for this year and next year. They are slightly lower than that of the government, but never, as in this occasion, I'd be happy to be wrong in vying with Riccardo. I'm joking, of course. Deflator, GDP deflator or inflation. The largest part of the reduction in inflation is due to the cost of energy, to the oil price, and the rest is due to the slack in the economy. So as we have a forecast for the oil price that will go up slightly next year, and you see that the deflator, the GDP deflator, is very linked with the oil price, and at the same time we have a recovery in the Italian economy. So less slack in the economy, the forecast is for an inflation above 1% next year. And for the debt, private and public, this is a good news. Next issue, next point is the level of interest rates. Now we have to distinguish between short-term rates or policy rates and the long-term rates. Policy rates are expected to be kept low, very, very low, not only in next year, but in the foreseeable future, I'd say. Also because before a hike by the ECB, the ECB should stop what they are called the unconventional measures. I mean, the QE or the purchasing program. And not only an end is not in the cards, but it's very likely that we'll have a put-off, a postponement of the end of the program. So short-term interest rates are expected to stay very low. And not only, if you look at this chart, this is what the main central banks, Bank of Japan, Bank of England, the Fed, the ECB, have bought so far in terms of bonds. As you can see, the area regarding the ECB is the gray one. It's here. And if we look at the global level, it's quite marginal. It's no more than 10% of the global purchases of the other central banks. So there is this to say that there is room to increase the amount of purchases. Another point which I think is quite important is the fact that ECB policy is playing an important role in order to protect against risk aversion. Look at this correlation. This is the correlation between US Treasuries and a bond on the 5-year maturity. And as you can see, recently, the correlation went down. So there is almost no correlation. Bye-bye, Ricardo. And this is very important also to say that the spread can go down, notwithstanding an increase in the VIX, in the volatility. So what's the bottom line for that? Is that the cost of debt will decline further. Here we have many hypotheses, but even in the stress hypothesis, which is that of a huge increase in the level of interest rates, we have an absolutely manageable burden of interest expenditure. This is the primary balance. Here we have many forecasts, the government one in red, and the IMF and the Intesa Sanpaolo forecast. We are in the middle, but in every case, we are around 3 to 4% of GDP. So, summing up, the outlook seems to me that it's very favorable in terms of GDP growth, in terms of interest rates, short and long term, and in terms of primary balance. Of course, nothing is easy. There aren't free lunches in financial markets, and so we have to take into account also some risks. The first one is that the debt consolidation is going on during a phase where there is a global slowdown in nominal GDP due to the emerging markets, the emerging countries' behavior. Second, is not exactly clear what is going on for the Italian industry after this huge drop in industrial production and in investment. So what is the real sustainable growth for next year? And the third point, I think this is a weak point in the government strategy, is that the contribution from privatization is quite limited. However, and this is, I'll skip this, and this is my very last slide. And probably this is the most promising chart of my presentation, where you say a picture is worth more than 1,000 words. Here what we have the R minus G. R is the level of real interest rates, and G is GDP growth. You see that from this level, which was very high, because you have to read it on the right-hand scale, so the real interest rate was higher than the GDP growth by 4 full percentage points. Now we're going close to 0, which is due to the fact that we have lower interest rates and higher GDP growth. This is the recipe for that sustainability. The other issue is that the primary balance will be slightly higher, helping the stabilization of public debt, but at the same time supporting domestic demand and, I hope, total factor productivity. We need in Italy to increase substantially the productivity of our economy. So, summing up, I don't think I've been quite original in my presentation, but I think I put in order some figures and some reasons to explain why investing in Italian assets is a good investment to keep or to increase. Thank you very much for your attention.